What are the different order types? When trading stocks, there are a number of different orders you can place. These orders are instructions for when and how you want the stock to be bought or sold. Which ones you choose are dependent on your investment strategy and style, as well as share price fluctuations. A market order is used when you want the order guaranteed to be executed immediately and are willing to risk getting a different price. The order is executed at the best price available at the market. A market order ensures the fastest execution of the trade. But the price may be different from the last price quoted by the fluctuation between the time that the order is placed and the time it is filled. Let's say you place a market order to buy 10 shares of XYZ stock, which has a current best ask price of $50 per share. Your order will be executed at the best ask price. If the best ask price has risen to $51, the order will be executed at $51 and not at $50. Conversely, if the best ask price has dropped to $49, the order will be executed at $49. But what if you want to buy XYZ stock and you don't want to pay more than a certain price? Then you can place a limit order. A limit order is used when you don't want to buy the stock over a certain price. Limit orders differ from market orders, as they may not be executed immediately, and you do not run the risk of buying the stock at a higher price. You can also use limit orders to limit the price at which you sell your stock. However, with limit orders, there is a chance that the desired price will not be reached, and therefore no trade will be executed. So suppose you want to buy 10 shares of XYZ stock, which has a current market price of $50 per share, but you don't want to pay more than $47. You place a limit order, and if the price of XYZ stock falls to $47 or below, your order will be filled. However, if the price never drops to $47, the stock will not be purchased, even if the price drops to $47.01. A good till date order is used when you want to buy shares at or below a certain price, and only before a certain date. It is a type of limit order with an expiry date. If the order is not fulfilled before the date you specified, it will automatically be removed from the market when it expires. Let's say you wanted to purchase 10 shares of XYZ stock before the end of June, but only for $50 or less. You can set a good till date order, which will cancel your order if it cannot be fulfilled by the end of June. Now, suppose you bought a stock that has performed very well. You would like to hold on to it, but you are concerned that the price might fall. To protect your gains, you can place a stop order. A stop order triggers the shares to be sold once the stock reaches a specified price known as the stop price. This is also called a stop-loss order and provides protection by letting you set your own loss threshold. Let's say you have a $50 share of XYZ stock and you place a stop-loss order for $45. If the price of XYZ drops to $45, a market order will be triggered and your shares will be sold but at the current market price. This could be below the stop order price of $45. Similar to a stop order, a stop limit order also adds a limit to the price which you sell your stock. This gives you even more security. If a stock price drops to a certain point, this triggers the stop limit order. The trade is only executed at the limit price or better. Going back to your XYZ stock, which is $50 per share, you place a stop limit order of $45 as you want to sell your stock if the value begins to drop, but don't want your stock to be sold for less than $45. If the stock hits $45, a limit order is triggered and only gets executed if the stock's price is $45 or higher. If it falls below $45, the stock is not sold. Now that you have learned about some of the different types of orders, which ones will you use on 8 securities?